Welcome to The Explainer. So let's just jump right in, shall we? Today, we are completely tearing down the walls around one of Wall Street's absolute most powerful and honestly, historically exclusive income-generating structures. I'm talking about the Collateralized Loan Obligation, or CLO. For decades, this was basically an institutional playground, totally reserved for pension funds and billionaires. But the whole ETF wrapper revolution, it's changed all of that. It is literally bringing institutional credit strategies straight to the retail market. So today, we're going to deconstruct exactly how these structures generate their income, how they protect investors, and the crucial stuff you need to know before you even think about putting them in your portfolio. Now, if you are an income-seeking investor right now, this is the literal million-dollar question, right? Traditional fixed income yields are facing this incredible uphill battle against inflation and these wild shifting interest rate risks. You want meaningful yield, we all do, but usually reaching for it means you have to step way down the credit quality ladder and take on some pretty dangerous default risks. It is a true dilemma. How do you generate strong, resilient income without leaving your portfolio entirely exposed to the whims of the next credit cycle? Well, that is exactly the problem CLOs were engineered to solve. Okay, so here is our roadmap for today. We're going to hit the search for yield, the anatomy of a CLO, the payment waterfall structure, floating rates and income, and lastly, retail access through ETFs. We're going to safely navigate all of this without getting bogged down in the Wall Street jargon. Starting with Section 1, Anatomy of a CLO, inside the structure. Before we can even begin to understand the income side of things, we have to define exactly what is sitting inside this financial vehicle. So, by definition, a CLO is an asset-backed security issued by a trust or special purpose entity that's backed by pools of loans. The easiest way to think about it, it's kind of like a giant financial factory. The factory doesn't do a whole lot on its own. Its entire purpose is simply to acquire raw materials, process them, and then pump out a highly structured, finished product for investors. And those raw materials? Well, they're hundreds of corporate debt obligations. We're talking domestic and foreign senior secured loans, senior unsecured loans, subordinate corporate loans, which, by the way, often includes those covenant-light loans that have fewer maintenance requirements, and even high-yield bonds. For the most part, this is below investment-grade corporate debt. Now, on their own, these individual loans can be incredibly risky, but the absolute magic of the CLO is how it pulls hundreds of them together to basically diversify away that single company risk. Moving on to Section 2, the payment waterfall structure, risk and reward. Okay, so we've got our giant pool of fairly risky loans, but how does this factory turn that into safe, structured income? We transform those raw loans into tiered income using a tranche system. And the best way to visualize this is to imagine a massive champagne tower. Sadly, we aren't dealing with actual champagne here, but rather the interest and principal payments from all those underlying corporate loans being continuously poured from the top. The top glasses represent the AAA senior tranches. They get filled first, always. Because they are the lowest risk and structurally protected, they offer a lower typical yield, usually hovering around 5.5 to 6.5%. Now, the glasses all the way at the bottom, those are your mezzanine and junior tranches. The champagne only reaches them if all the glasses above them are completely overflowing. If some of those underlying corporate loans default, meaning less cash flow champagne is being poured, those bottom glasses run dry first. They absorb the losses. But in exchange for taking on that high risk, they offer much higher yields, typically in the 8.5 to 9.5% range. This setup just brilliantly illustrates the whole risk versus reward profile of this structure. Seriously, just look at the NAV volatility. Because of incredibly strict coverage tests and that subordination feature we just talked about, those AAA senior tranches are unbelievably insulated. Historically, they experience only about 2 to 5% volatility while still paying out nearly 6 to 6.5%. Meanwhile, the BBB to B mezzanine tiers at the bottom, they can experience 10 to 20% NAV volatility. It is a beautifully engineered system where the risk takers at the bottom are literally providing a structural cushion of protection for the conservative income seekers up at the top. Let's jump into Section 3, floating rates and income, the mechanics. We understand the structure now, so let's look at the actual engine generating this yield, 40 to 100 basis points. That is the typical yield premium AAA CLOs offer above traditional AAA corporate bonds of the exact same duration. To put that into perspective, the crucial takeaway here is that you're getting a very significant income bump, all while maintaining top-tier credit quality. Why? Well, CLOs are structurally a bit more complex and, historically speaking, less liquid than standard corporate bonds. Because of that, investors absolutely demand a premium for holding them. But here is the real secret weapon for income generation. CLOs are floating rate instruments. The income engine here is typically based on the Secured Overnight Financing Rate, or SOFR, plus a spread. And the best part? It resets quarterly. What does that actually mean for you? It means that if the Federal Reserve decides to hike interest rates to fight inflation, your CLO income naturally just adjusts right upward. It provides this built-in, completely natural hedge against the kind of interest rate risks that absolutely devastate traditional fixed-rate bond portfolios. Honestly, while traditional bond investors are out there panicking over rate hikes, CLO investors actually get to see their income engines rev up. Which brings us to Section 4, Retail Access Through ETFs, the Wrapper Revolution. Now, historically, to buy a single CLO tranche, you needed $1 to $2 million just to get a seat at the table, plus a whole dedicated team to analyze the complex legal indentures. That barrier? Completely gone today. But this wrapper revolution clears up a very, very common misconception I see all the time. People constantly confuse CLO ETFs with leveraged loan ETFs. Guys, they are completely different animals. A leveraged loan ETF owns individual below investment grade loans directly. If a company defaults, boom, the ETF takes the hit directly. A CLO ETF, on the other hand, owns the tranches we were talking about earlier with the Champagne Tower. They own the structured securities backed by the loans. That means CLO ETF investors actually benefit from those engineered structural protections, like subordination and coverage tests, which drastically, and I mean drastically, lowers the default risk, especially if you're in the AAA tiers. And the market right now is just rapidly expanding with actively managed solutions to help you navigate this complex asset class. Take the recent launch of the Pacer Barings CLO Market Flex ETF, ticker AAAP, and the Secured Credit Flex ETF, ticker PBSC. These funds basically leverage Barings' massive global credit platform to actively manage these portfolios for you. So instead of $1 million minimum, you can buy shares for around $25 to $50 on a standard exchange. You get daily exchange-traded liquidity, you can buy and sell during regular market hours, which is a frankly massive upgrade from the traditional highly illiquid over-the-counter CLO market of the past. But, of course, nothing is completely free, right? Institutional expertise comes at a cost. Managing a portfolio of complex structured credit takes serious resources, which means you are going to pay management fees, typically hovering around 0.39% to 0.49% for active funds like AAAP or PBSC. You just have to weigh those management fees against the excess yield and the structural protection those active managers are providing. Remember, CLO collateral managers aren't just sitting there. They are constantly monitoring those underlying loans. If a company's financials start to look shaky, they trade them out to protect the integrity of the tranches you own. So before you go all in, let's talk about the operational realities. Because let's be real, there are actual risks here to consider. First up, from a tax perspective, CLO distributions are generally treated as ordinary income, not qualified dividends. The IRS is absolutely going to view this as ordinary income, meaning these are generally best held in tax-advantaged accounts, like your IRA, if you want to really shield that yield. Secondly, while the actual credit quality of a AAA CLO is incredibly high, the market price of the ETF itself is subject to daily mark-to-market volatility. If there's a huge market panic, the price of your ETF might dip significantly below its actual net asset value. Why? Simply because liquidity dries up in the underlying market. That can happen even if the underlying loans haven't missed a single solitary payment. Which leaves us with this one final thought for today. We have seen exactly how CLOs pool risk, how they use that Champagne Tower waterfall structure to create these highly insulated income streams, and how they offer floating rate yields that naturally fight inflation. Now that ETF wrappers have completely democratized access, these high-end institutional tools are sitting right there on your desk ready to be used. The question is, as we look ahead to uncertain interest rates and whatever shifting economic winds are coming next, does your current income strategy actually have the structural, engineered protection to navigate the next credit cycle? Think about that Champagne Tower the next time you look at your fixed income allocation. Thank you so much for joining me for this explainer, and as always, keep learning.